So with us today, we have our loan officer, Mr. Daniel Marlin with Century Mortgage. And Daniel's going to talk to us about the basic process of how to get a home loan and how to get pre-qualified before we start looking for your next home. So Daniel, what is the next step, or what happens in the process when I send the buyer to you? What do they need? What are they going to do when they come in to get a home loan with Century Mortgage?
Well, that's a great question, Aaron. The home buying process is a fairly straightforward process, and the first thing you want to do after connecting with your realtor is finding a good loan officer or mortgage originator to help you find the right loan product to get you into the home that you're looking for. The first thing we're going to do is get you what we call pre-approved. And what that is where your loan officer is going to collect some of your basic information from you: full name, date of birth, social, most recent 2 years of residence history, most recent 2 years of employment history, and a few other details here and there. The first thing we're going to look at is your credit report and your credit history to determine if you are credit eligible. A loan officer, what I like to call, is what we're always looking for is a diamond in the rough. You know, the 4 C's of picking a diamond. Do you know what they are?
Let's see, we got cut, clarity, carat, and I can't remember the fourth one, Daniel.
Color.
Color, okay, color.
Loan officers, we're looking kind of for the same thing. The 4 C's of the home buying process are character, capacity, collateral, and capital. I always forget that 4th C in there. Character is your credit history. You know, kind of a notion in the lending history, or lending process, if you will, is future performance is based upon past performance. If you've responsibly managed your debt in the past and responsibly paid your bills, then you're more likely to do so in the future as well. Conversely, if the opposite is true, then you're unlikely, or we are skeptical, that you're going to be able to responsibly make your mortgage payments in the future, which may lead a lender to not lend you the money. The next thing is capital. That is your down payment, or your ability to put money down. Ever since the housing crisis, a lot of lenders like what we call skin in the game. We want that homeowner to be personally invested into that property. Next is your collateral. That's the house you're buying. You know, what is the value of the house? Is it worth $200,000, or is it worth $195,000? You know, and what is the condition of the property? Because depending on the loan product that you choose, each loan program has minimum standards that that property must meet. And then last but not least is your capacity to repay. And what that is an examination of your income versus your monthly debts. Are you going to be able to afford the house you're going to want to buy while still being able to manage your other finances for the month? The conglomeration of those 4 items is really what determines a good homeowner.
So Daniel, you equated the home buyer to a diamond and talked about these 4 C's of character and capital, capacity and collateral. So how do we determine each one of those?
That's a great question. Like I previously mentioned, your character is going to be your credit report or your credit history. Common things that report to the credit bureaus, positive and negative, if you will. Typical things you find on a credit report is a mortgage, if they've had one in the past, auto loans, student loans, installment loans. So if you went to your bank and got a personal loan that you repaid, and what we call revolving lines of credit, like a credit card. And those things are going to report it, you know, your balance, your payment histories. Have you paid on time? Have you been late? Negative items that may appear on there are collections. Let's say you've canceled your cell phone bill and you did not pay the final amount that they say you owed. Or medical collections. It is very common to see medical collections on a credit report. Also, if you have any judgments or liens against you. A judgment is where someone on a debt you have owed has taken you to court, sued you, and won judgment against you. And then lastly, a lien. Common examples of a lien is a tax lien. So if you have an unrepaid tax bill, they will put a lien against you to make sure that they get their money, if you will. Capital is, you know, your down payment. So have you saved it up the old-fashioned way, if you will? Or are you gonna get a gift from a family member or a relative? Are you gonna cash in a 401k or an IRA or take a loan out against one of those for that? Or do you need down payment assistance? Or in the case of true 100% financing programs like a rural housing loan or a VA loan, which we'll discuss more in a little bit, those no down payment is required. So a borrower could literally buy that property with no money out of their pocket.
Okay.
And then you have the collateral, like we've talked about, the house, what is it appraised for?
Yeah.
The value of the property, the condition of the property, does it meet the minimum standards of that loan program? Other things is if it's a condo or a manufactured home, those things will also, affect the value or what loan programs may be available for it. And then last but not least, your capacity is your income. The lending world, we use or determine everything based upon your gross monthly income. So not your net.
Yeah.
It is based upon your gross monthly income. And we determine your debt to income ratio based upon your gross monthly debt versus any other debts that report on the credit bureau. So not every loan program or loan programs do not take into account how much you spend in gas every month or your cell phone bill. Those are things that are not typically on there, but most homeowners or most individuals, that's a standard debt that you're going to incur.
Okay.
However, VA loans, which is a little unique, they do take into account utilities on a certain level, and we can talk a little bit more about that when we talk about VA loans.
Well, I think that's a good segue into different types of loan programs. You had mentioned some about 100% financing loans and some about some housing assistance loans and things like that. Can you tell us about some specific programs and kind of like more common programs and how those work?
Absolutely. There's a variety of loan programs that are still available to homeowners, both first-time and non-first-time home buyers. The main loan products that are available consist of a conventional, FHA, VA, and rural housing loan. There are also both fixed rate and adjustable rate mortgage products that are available.
Now, do you see a lot of adjustable rate mortgages today?
Not currently.
Most of them are fixed rate now.
The 30-year fixed rate is still the most popular product available.
The king of the mortgage.
However, at some point in time, and to the right buyer, an adjustable rate mortgage is not a bad thing.
Yeah.
But there's still people who are a little squeamish and a little concerned about the risk involved with that. But for the right buyer, the educated buyer, it is still a great loan product that's available.
Okay.
Let's talk about the government loans, if you will.
Okay.
Government loan is an FHA loan. The FHA stands for Federal Housing Authority. Rural housing, also known as a USDA loan, because that loan is insured by the U.S. Department of Agriculture. FHA loans are insured by HUD, or the Housing and Urban Development. And a VA loan, which is insured or guaranteed through Veterans Affairs. Rural housing and VA loans are both true 100% financing programs, meaning that no down payment is required.
Yeah.
Each loan is insured, one through USDA, the other through VA. Rural housing assesses a 2% guarantee fee that is typically financed on top of the loan. So for example, on a $100,000 home, your total loan amount would be $102,040. On a rural housing also charges a monthly mortgage insurance fee of 0.4% of the loan amount.
Okay.
And that is actually going to be incurred for the life of the loan. You will pay the mortgage insurance for the life of the loan. VA charges a fee assessed on whether or not it is your first time using it or if you've used it multiple times.
Okay.
And depending on your branch of service and level of service, that fee may vary. And if that person is disabled through the VA, they may even waive that guarantee fee.
Okay.
The great thing about a VA loan on top of the 100% option is they do not charge a monthly mortgage insurance fee.
Okay. I didn't know that.
So it helps keep the monthly payment at a minimum to the borrower.
Okay.
Then we have your FHA loan. Now, FHA loans do require a down payment of 3.5%, and that can be given in the form of a gift from a family member or nonprofit organization, or if you're receiving down payment assistance through a nonprofit organization or some other program that's acceptable to FHA and HUD. They charge an upfront mortgage insurance premium of 1.75% of the loan amount, and then a monthly mortgage insurance fee of 1.35% monthly. And there is some variance to that. If you were to put at least 5% down, it reduces down to 1.3. And then if you were to put, if you put 3.5 or anything less than 10% down, you have to pay the mortgage insurance for the life of the loan.
Okay.
However, if you put 10% down at that point, you would only have to pay mortgage insurance for a minimum of 11 years.
Okay.
A conventional loan is insured by what we call PMI, or a private mortgage insurance company. There is no upfront mortgage insurance premium. There is simply a monthly fee that is assessed. And that monthly fee will be a combination, is determined by a combination of both the loan to value, which is how much money you are putting down versus the value of the property, and the borrower's credit scores will have an effect and a determination on that. And maybe even the debt to income ratios. If their debt ratios are high, they may require a little more mortgage insurance to protect the lender in that instance.
Okay. So Daniel, you were telling us some about the conventional loan, and most of us, we think about a conventional loan being that 20% down, a pretty big chunk. Are there other options with a conventional loan, other down payment options?
Yes, a conventional loan, you don't have to put 20% down to go with a conventional loan. The 20% down, if you put 20% down on a loan, no mortgage insurance is required at any point in time in the life of the loan.
That's a good thing.
That's a good thing. However, if you have certain credit scores, you can put as little as 5% down and go with a conventional loan. It will just be an insured conventional loan, and that's where the mortgage insurance would come into play.
Okay. So what would be the advantage of choosing a conventional loan over like a standard FHA? If I can do 5% or 3.5 with an FHA?
The benefits is it's really going to be a case-by-case situation. If you have a high credit score and low debt to income ratios, going conventional will be a potential positive for two reasons. If you have the ability to put 5% down, first of all, but if you have high enough credit scores, a conventional loan will now allow a borrower to receive a gift for that 5% down. Where in the past few years, it was the first 5% down must come from the borrower's own funds. But the mortgage insurance will most likely be cheaper for that conventional product than the FHA, and you would not have to pay the mortgage insurance for the life of the loan.
Okay, yeah, that's another big plus.
And we at Century, we have a product called lender-paid mortgage insurance, where the borrower accepts a higher rate and the lender pays the mortgage insurance through the rate. So the net effect is a lower overall monthly payment because that borrower is not being assessed that monthly fee. So it's a great option. There are plenty of options out there. And anytime you're talking with a loan officer, you want to make sure that he or she goes over all of the options available to you. Because you as the borrower, you pick the loan product that you feel is best for you. We are there to educate and to guide you, but it is you, the borrower, who makes the ultimate decision as to which loan product best meets your needs and your budget and your lifestyle.
Yeah, I mean, there's so many products out there. We can find something that fits you best.
Absolutely. You know, the housing crisis is over.
Yeah.
You know, things have stabilized. Things are on the upswing.
Yeah, I mean, even from a real estate perspective, I mean, the market is going very, very well right now.
Yes. And lenders are out there, you know, we're out lending. We want to help buyers in the parameters in the lending world that exists today, help as many homeowners realize, or potential homeowners realize, that dream of owning their own home.
Yeah. So Daniel, we've kind of talked about different types of loans and different loan programs. What about length of loan, like term of a mortgage? I mean, we sort of think in the housing market of like the standard 30-year housing mortgage. Are there some other options there that we might have for some of these programs?
A 30-year fixed rate mortgage is what we call a traditional loan product. But there are a variety of non-traditional loan products that are out there. For example, a conventional loan, you can go anywhere between 10 and 30 years in 5-year increments. So you can go 10, 15, 20, 25, and 30. Obviously, the shorter the loan term, the higher the payment. However, you're going to see significant savings on the interest over the life of that loan.
Yeah. And typically, you have lower interest rates at a shorter term.
Yes. The shorter the loan term, the lower the rate, usually. FHA offers and VA offers on both a 30 and 15-year option, and rural housing is only at a 30-year fixed rate.
Okay. Okay, so Daniel, we talked about what you look for in a potential borrower, and we've talked about some different programs that are available to borrowers. So if I want to come work with Century Mortgage, what documentation do I need to have? What do I need to bring with me when I come to sit down and talk to you about finding a home loan?
Aaron, that's a great question. The documentation that we're going to need when you're getting pre-approved to buy a home is going to be about the same that any loan officer is going to ask for. So this is a pretty good general question for anybody. When getting pre-approved, the following documentation is always good to have handy. Your most recent 2 years of federal tax returns, and what I mean by that is your Form 1040 and any schedules of income. Your W-2s, bank statement, most recent bank statement, and your most recent 30 days of pay stubs. For the hourly or salary employee, the pay stubs is going to be the big thing we're going to look at. However, if someone is self-employed or someone is commission-based or even base plus commission, the only way to determine those individuals' income is to analyze their most recent 2 years of tax returns.
Okay.
Because any loan officer, what we're looking for is what we like to call stable and continuous income. So we don't want to see that you lost $50,000 year over year in income, because that's declining. That's a bad thing. But if you made $30,000 in 1 year and 33 the next, or even 33 1 year and 30 the next, that's pretty stable. That's pretty continuous. We're trying to avoid huge fluctuations up or down in your income. Once you sit down with your loan officer, we're going to take your information, and then we're going to start verifying things. We're going to compare the pay stubs to what we've looked at over the phone to the tax returns to make sure everything matches. In the bank statements, we are looking for large deposits, because that is a potential red flag, especially if it is not from a direct deposit. Most employers now pay their employees through direct deposit. So if we see large deposits that are just non-direct deposits, we may scrutinize that, and the underwriter or the loan officer may ask the borrower where it came from, because we are required to know any funds a borrower is bringing to close must be sourced or seasoned. Seasoned means the money's been sitting in your account for at least 2 months. And I like to joke, it's sitting there collecting dust, not interest. Or we have to source it. And what that means is we have to prove where that money came from. Did you sell something? Did you receive a gift? Or did you save it up the old-fashioned way, if you will? If you are getting into a situation where a borrower is getting a gift, and this is the most important thing I can tell you as a borrower, is that donor, whoever's going to provide you the gift, they must be willing to provide your loan officer with documentation to show where that money came from. Inevitably, with a donor, they're not going to want to do it. So it's best if you can educate and provide, let that donor know up front that, hey, this is what they're going to need. So that way they are better prepared, and they're not sidelined, halfway through the loan process, if you will, or even at the beginning of the loan process with something they may not be comfortable providing you with. Last thing, I guess the only thing we haven't really touched on is problems. What can potentially... That's
a good point. Well, what kind of problems? What are some typical problems that you run into in this process?
The two major things, or the two most common things we run into, are bankruptcies and foreclosures. Okay, and also an extension of that would be short sales or transfer of deed in lieu of foreclosure. Bankruptcies and foreclosures. Whenever a borrower has a bankruptcy or a foreclosure, you are simply, how I like to describe it, you are in timeout for a period of time. There is a mandatory waiting period as short as 2 years, as long as 7 years, depending on the loan product, credit score, and other items on there.
That's a really good way to put it,
So it is important, once you incur or have one of those life events occur to you, to start trying to rebuild your credit history. Life happens sometimes. And, it's tough, it's difficult, but you can buy after you've had a bankruptcy.
Yeah.
You can buy after you've had a foreclosure.
Yeah.
It's not so much a matter of if, it's more a matter of when.
Yeah. That's a really good point, especially after, you know, the things that happened a few years ago with, you know, the big housing bubble burst.
And one thing that may surprise home buyers that could be a potential hurdle is divorce. And not divorce in and of itself, but the effects of obtaining a divorce. So oftentimes I've seen people, after they have suffered you know, a divorce, that their credit has taken a hit as a result of that.
Yeah.
Sometimes by no fault of their own, and sometimes it's, you know, life happens, and it's hard
it's
to
a traumatic event.
refocus
Yeah.
after something like that.
Yeah.
But, you know, the important thing to know is when you've had those life events, or you've just had a rough patch, and you've had to file bankruptcy, or you've had to have a short sale, that lenders are out there to help you, you know, work with you and guide you, so that way, once you are out of that time period, that you are prepared to buy, and we can get you into a loan product that's gonna meet your needs and your lifestyle going forward.
Okay, so Daniel, this has been some great information today. I think we got a nice general covering of what's going on.
I think so too.
What I will do, I'll put Daniel's contact information, a link to his webpage in this description if you'd like to contact him, or if you'd like to contact me at homesoverriver.com. I'll put our contact link there too. If we have any questions that we can answer for you to help you in your next home purchase, we'd love to help you out if at all possible. Thanks for watching our video. Like I said, this is our second video in a buyer's journey. We got our third one coming up pretty soon, hopefully to get it done. But like our YouTube video, like our Facebook page, check us out on Facebook at homesoverriver.com, and check out our website, www.homesovertheriver.com. And again, we sell in all of southern Indiana and the Louisville metro area. And thanks for checking us out.